Welcome back to another explainer. If you've ever opened up an investing app and felt like you were staring directly into the matrix, hey, you are completely normal. I mean, we're talking jagged lines, zigzagging everywhere, weird flashing boxes, intimidating acronyms popping off the screen. But look, by the end of our time today, we're going to strip away all of that intimidation. We're wiping the slate clean so you can glance at any stock chart and instantly know what's going on, literally in under 10 seconds.
It's totally natural to look at a standard financial chart and just think, what on earth am I even looking at? Beginners usually get this sudden rush of pure overwhelm. Honestly, it looks like you need a PhD in advanced mathematics just to figure out if a company is doing okay. But here's the kicker. Financial software companies actually design these charts to show absolutely every possible metric all at once. And sure, that's great for day traders, but for the rest of us,
So I want to empower you right out of the gate here and let you in on a little Wall Street secret. 90% of what is on that screen, it's just useless noise. For the vast majority of us, especially long-term investors, reading a stock chart is actually incredibly straightforward. You don't need to memorize every single metric. You really just need to know how to filter out that noise and focus in on a few core foundational pieces of data. Okay, let's dive into this. Here is our roadmap for today to prove how simple this really is. First, reading the frame. Then, zooming out on time. Third, decoding the candlesticks. Fourth, spotting the trend. 5, checking the volume. And finally, ignoring the noise.
Let's kick things off with Section 1, reading the frame.
To really get a handle on this, we're going to do a teardown and a rebuild. Let's mentally erase all those fancy indicators and start with a completely blank grid. Because fundamentally, every stock chart in the world is just a simple grid serving as a visual history of price movement. The vertical line on the right side, the y-axis, just tells you the price in dollars. The horizontal line across the bottom, the x-axis, well, that's time. That is it. Every single point on that grid is just a real trade that actually happened between a buyer and a seller. Think of it like a simple weather forecast, right? But instead of showing the temperature over a week, it's showing a stock's price. It's just answering, is the price going up, going down, or staying flat?
Moving right along to Section 2, zooming out on time.
Usually at the top of your app, you're going to see a time frame toggle with letters like 1D, 1W, 1M, or 1Y. And listen, this is where beginners make their absolute biggest mistake. So I want you to memorize this golden rule right now. Zoom out before you stress out. When you're investing for the long haul, it is so easy to panic over a bad day or a bad week in the market. But a stock can look totally terrible over a 1-week span and still be crushing it over a 5-year period. So you definitely don't want to draw conclusions about a company's health from just a tiny, microscopic snapshot of time.
The difference is actually wild when you compare them. Look at a one-day chart, and you're seeing every tiny, chaotic little wiggle from today's trading. I mean, it looks like a terrifying roller coaster. But if you just click over to the 5-year chart, all those stressful daily wiggles totally vanish. What you're left with is the true long-term story of the company. So, my advice, ignore that daily noise. Stick to the weekly, monthly, or yearly views to get the real, unclouded story.
All right, on to Section 3, decoding the candlesticks.
Now, what's really interesting here is that most professional charts do not use those simple line graphs we all drew back in high school. Instead, they use these little blocks with thin lines sticking out of them. We call them candlesticks. And I'm going to demystify these for you right now because beginners see them and instantly assume they're super complicated. But they actually tell a beautifully simple story. A single candlestick is essentially just a mini history book for a very specific period of trading, usually one single day. And it packs 4 distinct pieces of information into one clean shape: the opening price, the closing price, the absolute highest price, and the absolute lowest price for that day.
It's incredibly intuitive once you know the basic color code. A green candle, which we call bullish, just means the price went up during that time frame. Simple as that. The price opened at the bottom of the solid block and closed higher up at the top. On the flip side, the red candle, which is bearish, means the price went down. The market opened at the top of the block, but by the time the closing bell rang, the price had fallen down to the bottom. Let's break down the exact anatomy of what we're looking at. There are 2 main parts to a candlestick. First, you've got the thick body, which tells you where the bulk of the action happened, exactly where the price opened and closed. Then you've got those thin little lines sticking out of the top and bottom. We call those the wicks or sometimes shadows. The very tip of the top wick shows the absolute highest price the stock touched that day, even if it was just for a split second. And the bottom tip of the bottom wick, that's the absolute lowest price. And here's a quick pro tip. If you see really long wicks, that's a fantastic visual clue showing high volatility, or that the market strongly rejected a certain price level.
Which brings us to Section 4, spotting the trend.
Now that we can read a single day's history,
we need to zoom out to the bigger picture. Honestly, the most vital question you can ask yourself when looking at a chart is simply, which way is this stock generally moving? Whether you're a total beginner or a seasoned expert, understanding that general trend is infinitely more valuable than trying to magically predict tomorrow's exact price.
Because there are really only three ways a stock can move, right? First, you have an uptrend, which is characterized by higher highs and higher lows. It kind of looks like a staircase climbing upward. Second is a downtrend, which is lower highs and lower lows, like a staircase tumbling downwards. And while it's not explicitly detailed right here, the third way is a sideways trend. That just means the stock is bouncing around in a flat range without any clear direction up or down.
To make spotting this trend even easier, charts offer a totally fantastic tool called a moving average. It's basically just a smooth line that cuts right through all those chaotic daily zigzags. Your app automatically calculates this by averaging out the closing prices over, say, the last 50 or 200 days. And here is the golden rule of trends. If the current stock price is sitting above this smooth line, it generally has strong buying momentum. If the price is hovering below the line, well, it's stuck into downtrend.
Along with that trend, you're going to start naturally noticing these invisible floors and ceilings on your chart. These are crucial levels you absolutely have to learn before you ever touch the complex indicators. A support level is like a floor. It's a price point where buyers consistently step in because they think the stock is cheap, which pushes the price back up. A resistance level, on the other hand, is like a ceiling. It's a price point where sellers consistently step in to take their profits, and that pushes the price right back down.
Now for Section 5, Volume, the ultimate lie detector. If you glance at the bottom of your chart, you're going to see a row of vertical bars. This is volume, and it is basically the ultimate lie detector test for stock prices. It tells you exactly how many shares were bought and sold during that specific period. Check this out. Let's say a stock jumps up 5%. If that jump is accompanied by massive, towering volume bars, it means big institutional investors are buying in. Millions of dollars are moving. That makes it a really strong, meaningful trend. But if the price jumps 5% and those volume bars are tiny, that means barely anyone is trading. It's a weak move, basically a fake out, and it could easily just reverse the very next day.
To really lock this concept into your brain, just think of a supermarket. High volume is like walking into a packed, bustling grocery store. There's a ton of activity, tons of interest. Low volume is like walking into an empty store where nobody's really around. So, when you see rising stock prices combined with a busy, high-volume store, that equals a much, much stronger trend that you can actually trust.
All right, bringing us to Section 6, ignore the noise. So, the crucial point here is that it's time to clear out the rest of the clutter. When you're first starting out, you are going to see a dizzying array of indicators. Just cross them out. RSI, ignore it. MACD, cross it out. Bollinger Bands and Fibonacci retracements, gone. Honestly, Fibonacci retracements sound way more like an expensive pasta dish than something you need to be worrying about right now. I promise you, these tools are totally optional. Sure, they might be useful for advanced day traders way down the line, but for now, they are entirely unnecessary for understanding the basics. Just ignore the noise.
Let's pull this all together and see how this logically builds into our final framework. We've torn the whole chart down and rebuilt it using only the stuff that actually matters. Step 1, always check your time frame first. Zoom out. Step 2, understand the simple green and red story that the candles are telling you. Step 3, look for the overall trend using that moving average line. Step 4, notice the volume at the bottom to verify if a move actually has real power behind it. And step 5, ignore the fancy indicators. If you just follow this simple 5-step framework, you can read pretty much any stock chart like an absolute pro, literally in under 10 seconds.
You've got the knowledge now. You don't need 10 glowing monitors on your desk to be a smart investor. You just need a little bit of clarity. So, I've got a question for you to put these brand new skills to the test right now. What stock chart are you going to look up first today? Drop your answer down in the comments below. Dive into your app, apply this 5-step framework, and see the matrix for what it really is. Thank you so much for hanging out with me for this explainer, and I absolutely can't wait to see you next time.